This is Dynamic Technologies presentation for the Board of Trustees. It was made by all four of us. We all contributed information to this presentation. We went with the color scheme that kind of like matched our logo, so that's why it's blue and all that. But we'll go ahead and start. We'll go ahead and start with the financial performance. We have 3 slides here. This is the first set. We'll start with net revenues. They've gone up steadily, but they really started to jump up in year 9 when special contracts were introduced. That's also when drones market growth really started to go up. And as you can see, by year 11, they've really overtaken the action cameras. We believe this is due to, of course, the increased market growth for drones, as well as the decreased market growth for cameras. That's where it was really present in year 11, and drones overtook them for the rest of the simulation. We also do think it's because our competitors started charging higher prices for drones. They went more for a higher price diversification strategy focused on increased quality in individual components, where we shifted our drones more toward a low cost strategy. For earnings per share, based on our earnings have gone up. So of course our earnings per share never really went down. They did kind of stagnate from years 8 to 9, because that's really when the competition actually started. That was when competition was at its fiercest between years, I believe it was between 8 and 10, because everyone was starting to finally get in the groove of things. We weren't really in any danger of not meeting investor expectations. Expectations were at 3 in year 8 and 4.25 in year 9. Meanwhile, our actual performance was our EPS was at $5, so we were still, $1.75 above investor expectations, and well above where we set our performance at, our personal performance targets at. All right, for return on equity, this is the one we really had trouble with later on. We didn't spend a whole lot of resources on dividends and stock repurchases because we wanted to focus on reinvesting our earnings in the company, expansion, robotics upgrades, all that fun stuff. But around, years 8 and 9, that's where we really started to notice, it's going down. We should probably start handing out larger doses of dividends and maybe start repurchasing stocks so we can get our return on equity up to be able to meet investor expectations. And that's had a very heavy influence on our financial strategy for how we've handled those things, especially after, that drop off in years 8 and 9. Kind of see where it stagnated there. Even in year 7, it started gradually going down. For credit rating, we've had pretty consistent credit rating since year 7. I mean, we haven't taken out any loans. We've been very conservative with how we spend our money, which is kind of how the whole return on equity issue came about, because we didn't see it as necessary to start handing out dividends yet. That's why we had that issue before. But our credit rating, we've never taken out really any debt since we've taken over. We had, I believe there was that 10-year loan that we had already taken out from people who ran the company before us. And the one time we really considered taking out a loan was in year 7 and 8, when we were debating on whether we should take out one to get the robotics upgrades early. But we decided to wait till year 9, when we could just pay for it in cash and not have to worry about our credit rating going down and not have to worry about repaying a debt over the long term. Our stock price, it never really went down. We never had an issue with stock price. Our biggest jump was in years 10 to 11, when it jumped from $200.84 to $275.48. We believe this is just because of our focus in low cost and the effectiveness that that's had in action cameras, and then for pretty much the whole 9 years we've had control of the company. And for drones, that really started to kick up once people started to shift toward a more diversification strategy, when we stuck with our low cost. This has also been a result of our production upgrades, increased production, which really gave us the potential to be able to take advantage of special contracts later on, combined with our low cost strategy. for image rating. We never really had an issue. I mean, it stagnated and jumped up, stagnated and jumped up in year 6. That's where it kind of stayed at 78, 79. And then in year 8, you can see it kind of jump up to about 83. And then by year 10, it was well up at about 91. And that's kind of where it stayed till year 11 when it started going up again. We ended at a image rating, I believe it was 93, 94 and investor expectations for that was, I believe it was 80. Yeah, it stayed around 80 for most of the, that's when investor expectations were at 80. All right. Yep.
So I'm talking about the performance targets for our years 15 and 16. So our performance targets, we always tried to base them above our investors and our investors' expectations. And then we try to go with the EPS expectations that go up to about $2 per year. And so that's for our years 15 and 16. And that will give us a rate from like 1450 to 1650 respectfully. I know that we usually shoot for about 50-cent minimum over the investors' expectations. So then that will leave us with a $15 to $17 for our goals. It takes on a similar patterns for our ROE, but our credit rating and our image rating, then the exceptions due to us being ahead of our expectations and reaching the ceiling performance. I know that we aim to add 1 point image per year to our current standing, but our credit rating, when it's at, I'm nervous. Our current standing at bare minimum is a credit rating when it's at investor expectations. I'm sorry, but I've kind of lost the page. Okay, I went off of it, so I'm ready.
All right.
For the next slide, yes. So I want to talk about our strategic vision as well. So we've always wanted to provide the best cost for our drones and have a good quality for our drones and our action cameras. And affordability has always been one of our highest goals, that we keep the good quality, but we leave it at an affordable price, because we felt like that would play a key role in reaching new customers, because that's what we want to do. We want to keep building on and getting new customers. And by the higher prices of the products of this nature, we just simply want to provide a line of products that most people can afford to buy. You go to the next one. Thank you. So our competitive strategy with our action cameras is, from the beginning, has been a global low-cost provider strategy for our years, the R&D expenditures in our overhaul to how we approach productivity. The last few years, the results have been pulled in, and we believe we have even shifted closer to a best cost strategy. And if you look at our PQ rating, it's relatively strong compared to our opponents when mastering the PQ ratings.
So for our competitive strategy for our UAV drone, we started out with a universal diversification strategy. We ended up shifting to a low-cost provider to gain a competitive edge over our competition. We focused on lowering the cost while also keeping our battery pack life at 25 to 30 minutes, which was a key feature in one of the UAV drones main selling points. And we were able to keep our lower costs by investing in research and development. You can go to the next one. So for our production strategy, two of our main aspects of our production strategy were cheaper assembly and higher than average production per product assembly team. And one of our goals was to keep our overtime under 10%. We were able to hit that. We're able to do that by investing in
Joseph, you cut out there. All right. All right. What I believe Joseph was saying was we always had a goal to keep our overtime at with at least a 10% cushion, basically meaning we have at least 10% difference in our projected overtime. So that way, if something happens where we get a lot more demand than we expected, we have that 10% in the back. So that way we'll hopefully still be able to meet the market demand. This was especially true with cameras because once special contracts got introduced, what we were really concerned about being able to meet that extra demand, assuming we acquire all 4 of the special contracts. So that's why we had a lot higher focus on productivity once those got introduced. All right, yeah, he was going to do this one as well. Like I said, our financial strategy was influenced a lot by meeting return on equity expectations for our investors. We started in year 8 with about 10 cents per share. And once it started to stagnate, once we really started to see our ROE go down because of our lack of previous dividend handouts, we started to do larger handouts. We started to repurchase more stocks in year 9. After the reason we didn't hand out dividends to shareholders in the beginning was because we wanted to focus on reinvesting our profit into the company to be able to expand production and be able to handle those special contracts and higher demand in the later years.
So our closest competitors for action cameras was Company A for the past 2 years. They tried to acquire special contracts that we were chasing after, but were not able to take a lot away from us. They also offered larger discounts and doubled prices, matching hours for year 13 in Latin America, which was at $255. And they had the highest market share for the majority of regions in year 13. And then next slide. So closest competitors for drones was Company B. They had the highest PQ rating for drone price in year 14 at 6.7, which was priced at $3,100 in North America. And they had the second highest revenue for drones in year 14 at $570 million. They also had the second highest market share and second highest number of units for most regions in year 14. And then next slide. So the action plan for years 15 and 16, we doubled our capitalization of low costs by using a large amount of R&D. This would make profit margins larger by using cheap processes to make better quality or same components. We also lowered our prices without compromising the profit margins. And we widened margins without lowering the prices. We also used large discounts on special contract offers and made profit. And we upgraded facilities and compensation to increase production power and productivity by using workstation upgrades and quality bonuses. So the lessons we learned were that the quality of work increases when we work together to complete it. And winning strategy requires the analysis of industry factors, competitor qualities, and evaluation of resources. We also learned that our company is at risk if we only focus on one detail instead of analyzing all of them. And then we capitalized on resources by seeing what made our drone camera industry attractive and see how opponents operated with the same knowledge.
That was our presentation to the Board of Trustees. It was made by all four of us collectively. I want to thank you for watching.